In this video, we're going to go over all of the companies that I have been buying up for the better part of 2025 and will continue buying, especially during this market downturn. I think every single one of these companies are really good investments for the short term and for the long run. If you disagree, you're probably going to think that I'm an idiot, I'm delusional, which you're correct. Let's get into it. I think that's a really good question. Why these stocks specifically? Well, first and foremost, they're proven winners with a history that's going to help me to sleep at night. I'm not going to be tossing and turning thinking, are they up or down by negative 20%? And by definition, they're dividend compounders. And the best part is, in light of all of the fear and the red in the markets, they're at valuations where I feel comfortable dollar cost averaging into week in, week out, month over month. And what do I mean by this, right? Number one, they're not speculative. Their business model or strategy just simply works. For example, they're profitable, they generate cash, their current dividend yield is very high, or they have a high dividend growth rate. At the very least, a dividend that is very sustainable. And I absolutely could be wrong, but I think each one of these winners will continue to outperform the market going forward. Next 5 years, 10 years, and dare I say even 20 years. But remember, I'm an idiot. This is not financial advice, so with that out of the way, let's talk about the first stock. It's going to be an ETF known as SCHD. This is a very easy buy for me because when we take a look at their stock market performance, their adjusted stock price total return past 10 years is 182%, which I think is phenomenal. But it gets better than that. Watch this. If we zoom back out to 15 years, now the total return is going to be 385%. That's accounting for the dividends as well. Now, when we break that down year over year, this is the that I'm taking a look at, SCHD, their CAGR, also known as the compound annual growth rate, is 12.2% year over year. And the question that I have to ask myself is, would I be happy with my money compounding and growing at a rate of 12% year over year based on historical data and what they have been achieving so far? I think the answer to that is yes, I would be pretty happy. Is it going to grow by 200% overnight? No. But I also don't look at dividend growth investing as a mean and as a pathway to explode my portfolio's valuation by like 100% by the end of 30 days. I don't have those type of expectations. Rather, I'm a part of the camp that believes in the methodology of the slow and steady compounding strategy. So if you don't resonate with that, you probably think I'm an idiot already. Like if you believe in yield max ETFs or doing options call trading, everything that I just said about SCHD and why I'm attracted to them goes right out the window. And the second thing that I really like about SCHD, why it's such an easy buy for me, is their dividend profile. Let's take a look at it. So SCHD is currently trading for about $26 a share. And when we take a look at their dividend yield, it's just shy of 4%. But this is the number that I care about, right? Year over year, it grew at 16%, which is actually inaccurate. It's closer to like 22 or 24% growth rate year over year. But historically, they've been growing their dividend payout year over year at a rate of 11.5%. And the proof is in the pudding, as depicted by this visual graph of their dividend payouts, right? 2015, you could have expected 9 pennies every 90 days or every quarter. And as we fast forward, yes, sometimes it goes down because depending on their portfolio holdings and their dividend distributions, it goes down. But over the grand scheme of things, it goes up. So sometimes it goes down, but it goes up. Sometimes it goes down and it goes up. So if we look at it from a bird's eye view, your dividend payout is essentially going from 9 pennies to that of 24 cents every 90 days. And you might be like, dude, what? That's nothing. However, when you think about it mathematically, a 4% dividend yield for every $100 invested into SCHD, you get paid $4 in dividends. Right? So if you bump it up and you move it up to like $1,000 invested into SCHD, then that's $40 in dividends. And if you bump it up even more, right? We're Americans, we're fat, we're overweight, supersize it one more time. $100,000 invested into SCHD gives you $4,000 in qualified dividend payments annually. And if I somehow win the lottery and I come across $1 million and I put that into SCHD, my dividend payout will be $40,000 for that first year. And then the following year, it's going to grow at a rate of 11.5%. Dude, There's so much to like about SCHD, but my favorite is that they help bump up my overall portfolio's dividend yield. And what makes all of this even more bizarre is that SCHD is the newest addition to my portfolio. I started to buy into them in the first week of April, and since then I've made no less than 10 to 15 videos and shorts just talking about it, right? That's my ADHD and ADD kicking in. Once I become fascinated with something, whether it's a hobby like board games or a gym routine or a stock investment, dude, I go balls out and I get heavily into it and I can't stop talking about it for the next 30 days until my next interest comes right into my brain. But anyways, the first one was SCHD. The next one is Microsoft. Now, Microsoft is a company, I have receipts, you can see it on your screen right now, where I've been buying into them whenever they dipped below $3.99 a share. And when they dropped down to $3.80, $3.65, I was pretty happy. I was doubling down and I was buying into them. I was smiling, but I did get a little nervous because when you buy into something and it dips further into the red, you start questioning yourself, right? Dude, am I making the right decision? Am I making the right call? However, based on my investing philosophy and looking at their metrics, financials, and numbers, I knew that I was going to be correct and on the right side of the path 300 days from now or even 2 years from now. Case in point, let's take a look at some of their numbers. The first one is going to be their revenue. Now you tell me, their top line growing from $143 billion in fiscal year 2020 to that of $270 billion for the trailing 12 months. It is just a beautiful thing to see. Visually, this is what we're looking at. Microsoft's business model and their enterprise customers, it just makes too much sense to me. And look at the growth rate of that revenue, right? Growing at double-digit rates except fiscal year of 2023. But what good is a company posting these types of numbers for their revenue if they're not generating free cash flow? Well, that's where it gets even better for Microsoft. Because when we take a look at their free cash flow per share, 2020, it was $5.89. And in the trailing 12 months, it's $9.29. And it would be a lot higher in the ballpark of $11 or even $11.25 if they weren't spending so much money on CapEx, which they have to. And when we think about Microsoft's dividend yield, dude, a 0.7%, it's tiny. But just like SCHD, the growth rate is double digits. So this payout right here is growing at a rate of 10% year over year. And check this out. When we take a look at their income statement and we scroll down to their dividends per share, just look at this beautiful picture. In 2020, you were paid $2.04 in dividends for 365 days. As you fast forward, look at the number of the dividends paid out just growing. This is beautiful. Past 12 months, you could have expected $3.24. And that's why when I think about Microsoft's numbers and their financials, I absolutely believe that Microsoft is one of the best stocks for beginners and veterans alike. Because it's fundamentally sound, it's a solid business operation, and they have a history and data to back it up where in the next 5 to 20 to 30 years, you're gonna come out in the green. That's not financial advice, that's just one idiot's opinion, and that's why I truly think if you're new to the stock market, Microsoft is one of the few buy and hold companies forever. Now, could I be wrong? Absolutely, because I'm not great, I'm not smart. I'm just the guy that spends too much time looking at the numbers and financials with a magnifying glass to determine whether or not this is indeed a really good stock. And to prove my point about Microsoft, they just reported their earnings, and across all business segments, they're experiencing aggressive growth. Their overall revenue went up by 13% year over year. Their cloud revenue went up by 21%. And even LinkedIn, their social media for business professionals, makes me want to vomit whenever I see corporate people circle jerking to a post and saying the generic response is like, they're lucky to have you. Congratulations. Oh, so nauseating. But anyways, my biggest takeaway from this earnings report is that Microsoft currently, as of right now, they're unable to meet the demand from all of their customers. So when you think about it, that's untapped revenue potential. They should be posting bigger bigger numbers, but they can't. And that's why I think their CapEx spending for this year and the next like 5 years is justified, because that CapEx is for the long-term vision and is going to allow their bandwidth and the amount of customers they can serve through AI, Azure, and all of their other different endeavors to keep the economic moat machine sailing on and on. However, the funny thing is CapEx got every penny on Wall Street bunched up, right? Because they were like, why are you doing this CapEx? We don't like it. And they started selling out of it. Come to find out, everything is fine under the engine. Under the books, behind the scenes, Microsoft is crushing it. And amid the tariff wars, another thing that is worth calling out is that Microsoft decided to raise the price of their Xbox gaming console because of the parts necessary and the supplies. It's going to cost a little more. So I think the consumers aren't going to be happy about that, but that's one of the consequences of the tariff wars. Now, hear me out. I think Microsoft's true valuation, based on their current projections and numbers that they're posting, should be $500 a share. So to see Microsoft flirting with like $420, $430 a share, I think there's plenty of upside from their current price point. Now, do I think they're going to reach $350 a share again in the near like week or two? Probably not. But if you do the math, $430 to $500 a share, there's still a lot of green left for this company. Now, as I said earlier, when I was doubling down on Microsoft as they were reaching their 52-week lows, at first I was like, yeah, dude, I'm getting a good deal. But then when they started trading flat and stayed near like 360, 370, I started to feel pain in my right nipple. I was like, dude, am I making the right call here? Come to find out, you fast forward 3 weeks later, I did make the right call. So I'm pretty happy about that. I hate boasting about my past investments or showing receipts, but I think that's what a lot of YouTubers do, right? They're like, I called it, while completely ignoring their other investments that went bankrupt. And that's one thing that I just don't do, right? I always call out my failures and the ones that lost me money, such as FMC. I bought 5 shares of that company because they were inherently undervalued without completely understanding their business model going in a boom and bust cycle. I didn't realize that it's not every day that their customers, their farmers, the agricultural corporations, they don't need to buy insecticides, pesticides every week. They'll buy a boatload for 1 quarter and use all of it up in the next like 180 days, and they may or may not order the same amount again or less. So it was a learning lesson for me. But I think going forward, I will talk more about my winners. And it's not because I'm trying to boast or come across as conceited or a know-it-all, but I think I'm shooting myself in the foot by not sharing with you guys of like my successes and my wins. By only talking about my failures, I probably come across as a complete idiot. Now listen, I am an idiot, but I'm only a partial idiot because my winners most definitely outweigh my losers. But anyways, let's go ahead and talk about the third stock that I've been buying up. And this one is Ares Capital Corporation, a BDC, ticker symbol ARCC, currently trading for about $20 a share. Reason number 1, take a look at their dividend profile. Their dividend yield is 9%. It's sustainable by design because they have to pay out at least 90% of their earnings as dividends. If they didn't have to do that, then of course the dividend yield would be like maybe 3 or 4%. But because they pay out most of their earnings as dividend distributions, it's high by design. So nothing to be alarmed about, and it's sustainable as their history shows. However, it is worth noting when it comes to BDCs, you're not going to see dividend growth rates that are bonkers. Sometimes it's going to be non-existent, like in the case of ARK. However, this 9%, or if you bought it at around $18 a share, then your yield on cost, your true dividend yield is closer to something like 10.5%, is sustainable. Now, would I ever want to go 100% into a BDC? Absolutely not. However, does it belong in my portfolio? Yes. And the next thing that I want to call out about ARK is their NAV per share, also known as the book value per share. And this is really important when it comes to BDCs because essentially it shows us the valuation of the BDC. Because when you think about it, for BDCs, their valuation is mostly from the loans that are on the books, their equity stakes in the businesses that they're helping, and their cash assets. So the book value per share shows us the valuation of the BDC growing. And to grow, they need more loans handed out to the businesses that they're financing and helping out. Now, the trend that you want to see when it comes to the book value per share is growth year over year or to be consistent. You don't want to see it declining year over year or to be volatile up and down. And in the case of ARK, take a look at this, right? $16.96 in 2020, and you fast forward 5 years, and now we're talking $19.81. So not only is it consistent and growing and going in the right direction, this number right here, $19.81, shows me their current market price is not overvalued and they're not trading for a premium. So that's a green flag. And the next thing that I want to talk about is their return on equity. And the return on equity is a metric that basically tells us how good a company is at turning your invested money into profits. So let's just go ahead and say something like 7% ROE. Then for every $100 of equity, your investment into the company, it generates $7 of profit. So the bigger the number, the better it is. And the return on equity is important because BDCs, as I alluded to earlier, they don't retain earnings, as 90% are paid out as dividends. That means with 10% of earnings left over, what can the management achieve with that? What kind of growth? And in a perfect world, the higher the ROE, the more income they make and higher dividends that are going to be paid out to you. And in the context of BDCs, this is the standard. If the return on equity is less than 7%, trash. They're absolutely weak. If it's a number between 7 and 9%, I would argue that's good. It's average. And 9 to 11%, that's above average, B plus territory. Anything above 11%, this is a very high quality, excellent BDC that we're talking about. Now, the past 12 months, the return on equity for ARK is 13%, which is absolutely wild because their 20-year average for their ROE is 9.8%, which is technically still good. However, ARK's management has just been driving the bus in a more smooth manner in the operations, and the results speak for themselves. Now, after I made my BDC ranking video about 3 months ago, it helped me to seal the deal on why I picked ARK. And I believe I made the conclusion that I really liked Trinity and Blackstone lending. However, all else being equal, it's going to be ARK, Blue Owl, and Main Street Capital because of their market cap and the amount of loans that are under their books. Because in the context of BDCs, bigger is actually better. A bigger market cap, more loans, more assets is better. And so when all of the BDCs were going on their sell-off back in March, I slowly started to build out my position into ARK, and I'm still waiting for Main Street Capital to hit about 40, 41 bucks. Will it ever hit that price point? Probably not, but am I happy with ARK? Absolutely. So that's stock number 3. Alphabet, aka Google. Now, fun fact, at the end of 2024, I decided to go against my investment philosophy by investing into AMD and Nvidia, hyper-growth semiconductor chip company stocks, and I got burned really badly. So, I'm not great. However, instead of doubling down on those investments that are also going on a massive discount and dip, Google is just a little more safer for me because their business model just makes too much sense. Now, let's look at why I bought into Google, the numbers. When we take a look at their revenue, in 2020, this is not $182,000. No, my friends and family, sit down because it's $182 billion. And as we fast forward throughout the years, just look at the growth rate of their revenue. It is absolutely wild to see it go from $182 billion to what it is in the trailing 12 months of $359 billion. Dude, that's absolutely bizarre. But As I said earlier, what good is it to have their revenue growing so much if they're not generating cash flow? So as we take a look at their cash flow statement and assess their free cash flow per share, is it a pretty picture? Well, it's going from $3.12 of free cash flow per share back in 2020 to what it is now of $6.05. So they essentially doubled their free cash flow per share in a span of 5 years. More so beyond the numbers and the financials, I think what I really like about Google is their economic moat surrounding their business model in the search and ads line of business, but also how they stay relevant with constant. I'm talking about they're innovating and pushing the boundaries of what's comfortable like Amazon, and they launch new products all the time. And also services. They're not afraid to spend that money on gambles and bets because they're making so much profit. And I think in the space of AI, people talk about how Google is going to be, the kids say, cooked. And I absolutely disagree with that assessment because it's not like Google is just sitting there and taking a beating and saying, we give up. We cannot compete in this AI space. No, they're spending a ton of money and they're making progress in their AI endeavors. Their Gemini chatbot, Google DeepMind, Google Cloud, Google Labs, they have a whole array of offerings and teams working really hard to stay relevant and to be a market leader in the future. Now, when I think about Microsoft and Amazon, I also think Google deserves to be a part of that conversation as the front runners of the AI space. And to prove my point that Google is still relevant and is growing beyond belief, they just posted their earnings very recently. And they're growing in all areas that are absolutely relevant. Their overall revenue went up by 12% year over year. Their Google Cloud revenue went up by 28% year over year. Their Google search that people are saying is absolutely done, it's obsolete, well, that grew by 12% year over year. Their YouTube ad revenue went up by 12% year over year. And by the way, hey, YouTube, I'm not seeing any of that. So please increase my pay, please. And what was really exciting about Google's earnings call is that Waymo, their robo-taxi service, now provides about 250,000 rides every single week. And it's only launched in select cities. So what I'm trying to say is imagine when Waymo does a GTM on a bigger scale and they go nationwide or even worldwide. The revenue potential from that happening, man, I am really stoked about Google's future. And something else that's kind of exciting about Google is that they're diversifying their business model. They're always doing it, but they're ramping up in cybersecurity because they just announced that they're going to be buying in cash $32 billion, acquiring this company based in Israel called Wiz. So they're also entering into the cybersecurity space so that they can bake it into their Google Cloud and their Google Office products. So as of right now, Google is worth about $164 a share. Year to date, they're down by 13%. However, based on my math, I'm an idiot, but based on my calculation, Google's true valuation should be $250 a share in a perfect world. If all of their antitrust probing goes away, they crush their numbers at double-digit rates for the rest of the year, $250 a share. More realistically, I think Google has what it takes, at least for the next 365 days, to reach a price of $220 a share. So, simple math, 164 to 220 a share, a ton of upside and a lot of green for Google. So, what do you guys think? I want you to poke holes in my investment thesis to these four winners that I am continuing to buy into. Tell me why they suck. I promise I'm not going to be offended. I really want to hear, why are they crap? Why should they be worthless? And what should I invest into? Like, which stocks are you eyeballing or buying up right now? Please don't be selfish. I shared with you what I'm doing. Please return the favor. I love you. Please. And on that note, I want to talk about some stuff that's happening in my personal life. So, as you can see by my background, I like the Seattle Seahawks, but I also really like Tottenham Hotspurs. Now, once Tottenham performs better, they might be the one on top and the Seahawks might be on the bottom. However, I think the Seahawks are also going to have a really good campaign this upcoming NFL season. Anyways, this week, something crazy happened. So Tottenham is currently in the semifinals for the Europa League, and they went up against this Wi-Fi passcode team known as Bodo Glimt. from Norway. And everyone was talking about how like they've been slaying all the giants in the Europa League and Tottenham is going to be the next one to fall. Dude, the score was like 3-0. Tottenham 3 points at about the 89th minute mark. And then, of course, we gave one away. So the final score was 3-1. But it just shows that, dude, Tottenham might go to the finals. And what's crazier is that Manchester United also played against this team from Spain or Portugal. I forgot the name. But they beat them 3-0. So it looks like the finals for the Europa League right now is going to be 2 Premier League teams, which I think is absolutely crazy. And between you and me, I think Tottenham will beat Manchester United. You can quote me on that because every single time we play against them, I mean, both our teams are trash in the Premier League. However, every time Tottenham plays against Manchester United, we beat them. So, if we do get ourselves into the finals, I think we're going to be having our first trophy. I think in the past, 20, 25 years, they have not won a trophy. This might be the first one, and I'm getting really excited. However, people are saying that for the second leg of the semifinals, when Tottenham goes over to Norway to play, things might not be as easy because when you think about their pitch, it's artificial. So they're not going to be playing on real grass, and the temperature in Norway is apparently freezing. And whenever people come over to Norway, teams from England or Germany or Italy, they don't play as well. So a little nervous, but more so I'm excited. And yesterday I had to go to work, and I usually bicycle to my job. Okay, it's 10 miles there and 10 miles back, and it usually goes fine. Right? However, right now, my quads, my hamstrings, and my ass cheeks are absolutely sore because yesterday, as I was pedaling my way over there, dude, 50 to 65 miles per hour winds just blowing me all over the place to the point where it was a safety hazard. There's a stretch of the road where I had to just pull off onto the sidewalk and just walk because as I was pedaling, the winds were so strong, it was blowing me into the fence and into other cars to the point where I felt like I was going to die. It's the first time in my bike commuting life where I genuinely was struggling to go past 10 yards, let alone 10 miles because the wind was blowing so hard against me. I felt like I have a full body workout. It's not just my lower body that's sore. Even my hands, even my shoulders, everything is sore. Because once I got to work, I had to put in a 10-hour shift. And so doing all of that, plus another 10 miles coming back home, dude, I'm absolutely drained. So filming this video, if you feel like I'm low on energy, it's not because I'm depressed. I used to be depressed for a really long time, but as of 2 years ago, I'm not depressed anymore. It's just that I'm genuinely physically exhausted. And the last thing that I want to mention is this is going to be my last real video that I'm going to be posting for a while. And when I say a while, I'm not sure when the next real video is going to go up. I'll make a detailed post in my community tab explaining what's up. So if you're curious to know what's up, go ahead and check out that post. I'll probably make it on Sunday or Monday. But anyways, take care of yourselves. Good luck in the stock market. Stay safe. And I'll see you guys eventually. I love you. Peace.